So we're going to talk about a strategic approach to performance management, i.e. the balanced scorecard. I see this at a lot of banks. The concept here is it's no longer measuring this performance strictly by the finance or the GL measures. I need to put in some customer measures. I need to put in some internal process measures, as well as my employees, learning and growth measures. So I'll walk through these four facets with a few examples. The importance of banking metrics or the finance piece. What's your return on assets? These are all the normal, boring financial ratios, debt ratio. What's my loan to deposit ratio, earnings per share, and net profit. So those won't go away. Obviously, you need to know how your customers are doing. Millennials, 1/5 of them are attriting or leaving every single year. What am I doing to retain them? Can I slow it down to only 1/6 of them leaving it every year? So obviously, you need to be doing customer satisfactions, market share. You open up a new branch, and you're on target when you did your demographic study to take 5% market share. Well, how are you tracking? Are you tracking it? What's your profit per customer? On average, maybe it should be $100. What are you doing to get it to $102? And then obviously increasing your wallet share. If you're measuring cross-sell ratio, I see typicals, it's 1 point something, 1.5, 1.7. Are you tracking it? What are your goals to get it over 2? Internal processes, number of new services. A lot of times, even on the teller line, how many teller transactions per teller per hour or per day? You want to have a metric. Are the tellers spending too much time? Is 100 transactions an hour good? So you need to measure that. What are the number of loans per loan officer? How many accounts can they possibly manage properly? You need to track that. And then lastly is how are your employees doing? What's the employee satisfaction? Are you holding them accountable to training? Do you pay for training? Are you tracking the number of hours that your employees are taking for training each year? Are there certifications? Are they going to banker's school? You want to track that because, again, you want to have improved performance on all four quadrants, if you will. Here's an example we call the balanced scorecard. Here's one I implemented a few years back. So this is for branches. You could have one for a product line. You could have one for a department. The sky's the limit. And here, this bank, what they did is their branch managers were measured on 10 specific goals. And the year would go along, and then once the year end was over, then accounting would spend the next month or two running all sorts of reports and diagnostics, sending them out to the branch managers. How do they compare to their goals? And by March, they would have their scores ready and then sit down with the regional exec and get their ratings and then decide, hey, you got a 1% raise, you got nothing, you're awful, but it was such a pain in the neck. So we came up with a balanced scorecard that would allow them to see how they're doing every single month. And if they're deficient in a measure, they could take corrective behavior, attempt to fix it or improve it before the year is over and the time was out. And so in this case here, we're looking at monthly loan growth is one goal. And I'll just sort of walk through this line. So there's a trend here, and obviously I've hidden column C through N. Every single month, hopefully your loans are growing. Sometimes your pay downs will be quicker than your production. But you've got an average monthly goal, and then on here in column P, the year-to-date monthly growth, if you added them all up, was $2 million. All right, over to the right is how do they stack up to their peers or the goals? And if they had below $2 million, they'd be in the first quartile or in tier 1. And if they scored below $2 million, they got a score of 1 on that measure. If they're between $2 and $4 million, they got a 2 on that measure. Between 4 and 6, they got a 3. And obviously, if it was greater than $6 million, they would get a 4 for that measure. Well, their monthly growth, when you added it all up, was 2.1 million. So they got a score of 2 on that one measure. Loan production, they did 10.8 million. So they blew it out of the water as far as loan production, just didn't get the growth they were looking for. So they got a 4 on that measure. But you can see they're using various measures that align with the branch manager's goals to determine the branch manager's performance. At the end of the day, they got a raw score of 20 and an average score of 2.5. If 4 is perfection and 1 is you're fired, they're in the middle of the pack. But they were able to get this report on a monthly basis, see where they needed help, and they would focus on those things to see if they could up their scores. Very, very motivational, and help folks improve a lot of performance. And that's the end of the day of CPM, is to improve performance.